Okay. All right. Looks like we're live. Looks like my audio is working. All right. Welcome everybody to Midas Investing Live. Welcome to 2026. New year, new me. I mean, not really. Same old me. But anyway, figured we'd have a short little show today. Probably not very long, just kind of going over a few things, but all last year I made all sorts of promises about trying to get back to some sort of regular schedule. So I was like, all right, you know what, new year, we're gonna really try. So here we are, kind of the first weekend in the new year. We're definitely trying to put a show on, and we're gonna try to keep it a little more regular. So maybe not a ton of things covered today. We'll maybe keep it a little bit short, but nonetheless, we'll have a little bit of a review going into the year. So anyway, first off, here's the portfolio as usual, of course. Nothing too much has shifted since last time we talked. I think I might have trimmed a little bit more some gold miners since the last time we talked, and then obviously my ETF strategy is kind of doing its own thing. So things do get changed out over here, and the allocations get shifted around on over here in this kind of right side of my portfolio on a regular basis. But we don't really need to discuss that because that's kind of its own strategy. As you can maybe note, I am allocated pretty highly to gold going into the year. That's just based off what that strategy is doing. But I am actually going to be shifting that allocation down on Monday because, again, that's just part of the ETF strategy, and the signal has shifted going into Monday. So yeah, it looks this is about 19% right here, but it will be actually about half that on Monday. So is what it is. But as I've said, this kind of side of my portfolio moves around a lot. You don't necessarily need to think too much about it. It's really just kind of the combination of these two slices over here. But in the main portion of the portfolio, the active individual stock portion of the portfolio, yeah, just the miners we did a little bit more trimming on, which I still need to do more trimmings on. We're still significantly over allocated to all of these. How much do I got in total? We still got 16.2% in gold miners, and I think it's like, I can't remember off the top of my head, but it's like half that. It's like half that, whatever my targeting is, and it might be less. I think it was half that last time we talked. Yeah, so 7.3%. So a little bit less than half that is kind of what my targeting system says I should have of that. But and I think a couple of them are starting to somewhat roll over on momentum, so we might get a little bit of a larger trim on them in the near future. But for the most part, we were just kind of letting those run. So to kind of briefly discuss, I guess, overview of 2025 a little bit. 2025 was a decent year for the portfolio. We did beat the market, but not by a lot, only by like about 1.5%, which I mean, it's good to beat the market. But in many ways, it kind of feels like a little bit of a letdown year considering just what happened in the portfolio. Because especially with the gold miners, considering how well they did and how well gold did and how allocated I was to those, you would assume that I might have done a little bit better. But unfortunately, there's also the other elephant in the room, which is FG, to which I was like 10 to 12% allocated going into 2025. And then over the course of the like next 3 to 4 months or so, I allocated up to, close to 20% or so. So my number one position going into 2025, I doubled down on in 2025. And then, well, unfortunately, the truth is, as you can see here, it was actually down about 28% or on a year-over-year basis. So technically this is like, off shifted by a day. It might not be exactly 28% for 2025, but give or take, well into double digits losses for our number one position in 2025. So like I said, it feels a little bit of a letdown to have basically had such massive home runs in the gold miners part of my portfolio last year, and to not like really blow out the market. But I mean, at least we kept up with the market. Considering our number one position was down 28%. But it required other positions to double, multiple positions to double their size in order to make that math work out for us. So yeah, we beat the market last year, but only by a relatively small margin, when frankly, it if this was going to be a good catch-up year for other years where we had actually not beaten the market, then, we would have liked a larger upside margin. So long way to say that, like, in a sense, I'm proud of how the portfolio performed last year, but in another sense, I'm also pretty disappointed. So, and on that front, FG, it is, a big discussion. They recently did their distribution of about 12% of their shares out to the FNF shareholders. FNF, their parent company, held about 87% of the shares prior to that. And so with doing so, they've dropped their allocation down to like around 75% or so. I'm not sure exactly where it is currently as of this day. But the distribution announced were finalized going into like the first 2 weeks of December. And I think that's kind of somewhat what you see going on here. Like this downward week right here, I think is somewhat partially in reaction to the final decided number on how many shares were going to be distributed, but also there was kind of increased concerns related to the whole private credit part of the story that was bothering us back in September. Also started to kind of show up here in these first 2 weeks of December. So I think that's somewhat of what this kind of larger downward candle is. But then we had kind of the follow-up candle here in the last week, which is when the actual distribution occurred. And that I think is basically wholly because of the distribution. Essentially what can be assumed is that FNF shareholders are going to receive a lot of these shares, and many of the shareholders will know exactly what FG is, and they'll know that it's a segment within FNF's business, and they'll probably appreciate receiving them and would like to have that allocation. But there's going to be other shareholders who are going to be more interested in specifically the mortgage refinance part of FNF's business, and maybe less interested in the insurance solutions part of their business. And so they'll get rid of the FG shares, not to mention other people who just won't even know what it is at all. And will just be like, wow, what's this random thing that just showed up in my account today? And then also there's institutions that have all sorts of specific rules and criteria on what they own, and what size and what type of beta, all sorts of criteria that can exist for different funds to hold certain things or institutions to hold certain things. So that's basically what this probably is a significant amount of that selling. And you can kind of see that standing out in the volume chart that I have down here. You can see gigantic spike up. The peak amount of volume that the stock has actually ever had was in the last week. So with 7.5 million shares relative to the trailing, I think that's a 3-month average I have right there of about 800,000 shares. So yeah, very, very huge, like about 9 times as large of the average volume of the last 90 days. When we had some high volume actually, or 90 days, I should say 90 weeks, because technically I have it on a weekly chart. So 90 weeks, but is it 90? Maybe it's not 90. Do I have it on? What do I have okay, it is 90. Yeah. I don't know why, but in my head that seemed like because I normally keep my charts on weeks a lot of times. So, but anyway, getting back to this. So 7.5 million shares. I did sort of try to think through this and kind of estimate like, okay, what can we expect from this? Because this was sort of expected. I was talking about this, a month ago when they made the announcement. I said, hey, they're going to distribute their shares. It's probably going to get turbulent. So here we are. It is in fact turbulent, like I said it was going to be. So I did sort of try to estimate what type of amount of shares you could expect to be sold because of this, and it's a pretty broad estimate. There's all sorts of assumptions going on here, so I could be heavily wrong. Don't take this as like some gospel math over here, but what I have here are the ownership lists of both FNF and FG, and this was like as of like 2 or 3 weeks ago when I did this. So what we have going on here is in this column, I'm basically have it look up the name on FNF's shareholder list and look to see if that person is a shareholder on FG. And if they are, we then shift over the number in this column over to here. Now, what's going on in this column, what I'm doing here is that you'll see the number 1 shareholder for FG, obviously, is Fidelity National Financial, who owns 82% of the shares. And so what I did is I took 1 minus that, which says, so the remaining amount of shares is about 17.5%. And then I went and said, okay, well, the actual number of shares as a percentage of that is this. So if you exclude FNF as a shareholder, then this is now the re-weighted amount of ownership that the other shareholders have. excluding FNF's shares, right? So out of the 17.5% of shares that is not owned by FNF, 22% of them are owned by Brave Warrior Advisors. Whereas out of all the shares, it's only almost about 4% of the shares. So you can see the difference. And so here you can see Brave Warrior Advisors is in fact a shareholder of FNF, and you can see the 22% shows up here. So you can see sort of what's going on here. Now, down the list, there are plenty of ones that they don't have a common shareholder for. And so that's why there's blanks here. And then what I did is I made a calculation based off of the change, the amount of shares there, to essentially estimate what I think the similar level of ownership would have been relative to FNF's ownership, which I have here. And then I count up all the ones where they don't have the common shareholder right here. And then here we sum up all of the ones where they don't have a common shareholder. And here we sum up all the ones where they do have a common shareholder. And then specifically, I'm isolating on the ETF managers, the big four large ETF managers being Vanguard, BlackRock, State Street, and Charles Schwab. And I'm essentially assuming that out of the ETF shares, because ETFs are, have their own specific criteria to it, I'm going to assume that there's going to be a significant amount of dumping there as well. Specifically, I'm just kind of making an assumption of about half of the ETF levels, and then I add in the 2%, which is the shareholders that they do not have in common. So you add those two together, we end up with about 7%. And then what I did is my assumption is that it would be somewhere between these two numbers, between 2 and 7% of the total non-FNF shareholders are probably going to permanently dump their shares. Now understand, when I say 7%, that doesn't mean that that's going to equal the volume level, because volume is a measure that measures the transaction itself. So it doesn't tell you buyers or sellers, it tells you specific transactions that occurred, which means technically speaking, there's sort of one buyer and one seller for each number in the volume. So what I did is I then multiplied each of these percentages by the approximate amount of shares outstanding, which is 4 to 12. And it gives me basically the estimate that I would assume that there would be between 4 and 12 million shares that would be sold specifically between that. So you take a midpoint of that, that's 8 million shares. 8 million sold would mean that you would need 8 million buyers. So you could end up having only 8 million in volume, but it could theoretically end up requiring almost double that, maybe up to 16 million. So that's kind of my estimate of the volume that would be required for likely dumpers of FG shares. Like I said, I can't really know who is or isn't going to dump their shares per se. So it's a total estimate. But within that, I would point out that in this first week, when they got rid of shares, we ended up with 7.5 million shares being turned over. So 7.5 million versus my estimate of a low bound estimate is the midpoint between these, which is 8 million. And then I'm willing to assume that it could theoretically be twice as much of that. So we got to 8 million, 7.5, 8, they're almost about the same. So that means we've sort of reached my minimum level in the first week, which is sort of good. It means that hopefully we're sort of through most of that pain. But I do think it's reasonable to assume that you could have another week just as bad as last week. Beyond that, I would assume that it probably would be sort of over, but it's very, very possible that we get another week that looks similar to this with a similar level of volume. It's also possible that you get a similar level of volume and it's spread out over a much longer period of time, right? So that's the other thing you sort of have to take into account, is that it's really hard to estimate these things because you don't know the timing of who's going to sell what when. And the price that the stock goes down to is based off of the balance between the buyers and sellers at each given moment in time. So long way to say that yes, we knew this was going to be painful. We knew this was going to be painful, and sure enough, it is. But hopefully, we're mostly through it in terms of the stock volume activity. Now, also, I kind of wanted to point out, coming over. Just take a look at since the stock IPO'd, here we have in green is the price, and then in orange is the forward PE. So just price versus valuation. I kind of wanted to kind of point this out because I know some of my viewers and people in the Discord who have definitely been frustrated in the last year with FG, which I don't blame them. Like I said, I've been frustrated. But I did kind of want to take a step back and look at the forest for the trees, if that makes sense, or not miss the forest for the trees, I should say. Which is to say that here you can look, you'll notice that the lines are very close. They're very close. There isn't a huge deviation between the price and the valuation change. And what that would imply is that, hey, Jeff, hey, Jeff, it's almost like you heard me. Hey, man. But good to see you. Happy New Year, man. So looking at the two together, if they're very closely tied together, that sort of implies that there hasn't been a significant change in fundamentals. But I would say that that's actually a little bit misleading because of the way that the valuation is shown here, which this is based off of normalized earnings, which means it's actually based off of the adjusted earnings that the company reports. And I would wind back and say, okay, you know, the stock went public at the end of 2022 and into 2023. And if we look at the numbers, you know, let's try to remember that at the end of 2022, revenues were $2.4 billion. And then the end of 2025, well, excluding Q4, because we don't know Q4 numbers yet, revenues were 5.6 billion. So we've still more than doubled our revenue in the last 2 years. And then yes, 90% of it showed up in 2023. And you could sort of argue that you could even significantly argue that a big bunch of that 90%, like a decent amount of that, was kind of an extra boost that they get just by going public. Like they sort of get a little bit of that upfront. You could argue. You could also argue that that's not true. But the point is, I'm just trying to give some caveats to any of the arguments I give, of course. So you could say maybe ignore the full double and just say, well, maybe from like 4 billion or up, you know, we're up like 30%. You know, it's like, that's good. There's still improvement. There was still revenue growth in 2024. So we still had solid fundamental growth. It's just been the stock, essentially, is what I'm trying to point out. It's the stock that's been screwing with us. And then, and yes, there are reasons for that, which involving the management. But then also I would point out that earnings as well, because again, I was just looking at the forward earnings. And so the valuation itself is based on the earnings, not on the revenues, right? Revenues is good when we get revenue growth, but at the end of the day, it's earnings that matters. So what I would then point out also is that, okay, looking at that, earnings in 2022 was $635 million in net income. And as of Q3, we're at 468 million. Didn't really mean to click on that. So if you look at that on its face, that makes it look like we're down in net income. But I would say that this is not adjusting for any like abnormalities. And as I was just pointing out, that valuation was working off of normalized earnings itself. And I would argue that 2022 was absolutely an abnormal year for this company and every other company in its industry because of the rate hikes. So I don't think that this is actually a good example of like the base year that you should use for assuming things off of. And like I said, I sort of said that that's true for the revenues. I would say that like you could argue that maybe you want to use like an average between 2022 and 2023. And I would argue you could maybe do the same between the earnings as well. As I would say is like really like our base amount of revenue that we started the stock when it first IPO'd, you could argue is more like a midpoint between that, which would be sort of a conservative estimate of way of thinking of it. And then I would say the same thing here, which if you did that, that would get you like, let's see, that's like almost 600. So divided by that, that's 300. So that'd be like 300 million on average between the two. And then if you then consider it from there, then that would make it look like earnings is actually up about 50% or so. Now, like I said, you can quibble with that. You can quibble all you want with my arguments about that. I would back up that argument by looking at some of these elements in here, like policy benefits. You'll see that policy benefits were kind of about 1,100, 1,200, 1,900, or I should say 1.9 billion, not 1,900, but and then 1.1 billion, and then suddenly jumped up to 3.5, 3.7, 3.6. So you can see that there's significant volatility in this, and we went from a high number in 2021 to a low number in 2022, and then back up to a high number in 2023. And this low number here is going to create high earnings here. And so, for example, if you literally took like an average between just the policy benefits for 21 and 22, it ends up being 1.5 billion. The difference of which for 2022 is about 400 million. So what I could argue is that therefore we're like 300 to 400 million too high in our net income on a normalized basis for 2022. So anyway, long way of what I'm trying to say is that I understand the stock has been brutal the last year or so. but I would argue that the fundamentals are still growing. You know, like we're still growing. The overall thesis is still working. It's just been a little bit of a devastating year in the capital allocation terms, which is really, you know, the key thing that's been hitting us in the teeth this last year. Jeff, was 23 a key retirement year for the booms, or is the $3 plus the real expectation? You mean, which part of the $3 plus? Was that their earnings in that year? Oh, the earnings was negative in that year. 3 billion policy benefits. Yeah, no, the 3 billion number probably is a more normalized basis as of the growth, because you got to keep when you take that into account. It's like, think about like if we did sort of have like because like the policy benefits are relative to the amount of annuities they have. So in a sense, like you could take policy benefits as a percentage of sales, but actually, like when I'm trying to project them, I think that you want the policy benefits to be relative to the balance sheet, and the balance sheet has been growing commiserately. So like this, you see how it averages like 3.5 billion or so for the last 3 years or so. That really does get you to a more normalized number, but it's that 3.5 billion is normalized around 5 billion in revenues, you know? So it's like when we have approximately 5 billion in revenues, it equals about 3.5 billion in policy benefits. And then another 500 million to a billion or so in other expenses. And then that gets us down to our operating income, which you can see it was very low in 2023. But if we were to maybe take like an average between the three, it would be like, what is that, 600 million or so per year on that. So 600 million relative to, like I said, about 5 billion, then that would be like 11 to 12% for the operating margin, pre-tax, pre-interest, which, you know, operating margins for a financial is a little bit of a weird metric to use, but yeah, so like these higher numbers in these more recent years, they do make more sense, and that is somewhat of an acceleration of the you're right, the boomer benefits being paid out. But yeah, looking back to these earlier years, what you can see is like the numbers are much lower, and that's partially because there was an acceleration there. But the acceleration of the boomer retirement kind of began in 2020, and so you can see like it didn't show up for those first 3 years really, and so I think really showing up here has larger to do with the revenue growth, and like I said, specifically the growth of the balance sheet, because really it's the size of the balance sheet that's going to drive the total number of the policy benefits. But also the size of the balance sheet also drives our interest and dividend income, and it also drives our interest expense, and it also drives a variety of the other metrics on our income statement too. Which that is pretty typical for a financial. Is like the financials. Your income statement ends up being driven by the balance sheet much more significantly. So anyway, yeah, like I said, long way to say that, yeah, it's been a rough year with FG, especially rough in the last handful of months. I still am feeling pretty good about it. Like, yeah, my sentiment is hurting, but nonetheless, I'm coming back over. It's like, look at the valuation. What is it? 5.5. We're at a 5.5 forward earnings. Come over to estimates, see what they're currently showing us for the year. It looks like we only have one analyst on this particular page. I know there's other services will sometimes will have higher amounts of analysts, but 13% is what's expected for this year, according to that one person. I think maybe this EPS will have more. Adjusted EPS, we have 2 estimates for at least, and they're getting 565, so that's a 40% increase. So we'll see what goes with that. There hasn't been, they didn't put the Q4 numbers out for the Limmer report, so I haven't been able to look at the actual annuity sales specifically, but we're going into it. And also, Mr. Blunt did buy more shares. Yeah, Mr. Blunt did buy more shares here on the second when we were having that large downward decline, which, yeah, obviously 5,000 shares is a a bit of a pittance relative to 7.5 million. So obviously he's not going to be able to be the buyback in the way what we would really like. But nonetheless, I think that shows that even he himself is saying, hey guys, this is all noise. This is all noise. It's like he's still accumulating. That's all. He's still out there accumulating. Technically, he did sell off some shares when he received a ginormous grant of them in the fall. But in terms of his actual open market purchases, he's still doing nothing but buying. Still doing nothing but buying. And yeah, I understand also. We can be mad at FNF for their handling of the situation, but I will say that as they do this, the next time, let's put it this way, the next time they do this, assuming that they have to do this again in the future, it will have less effect. It's like each time they do this, it sort of creates it lessens the effect of the future time. By distributing these shares, they've basically doubled the float size, which means that it's effectively has lowered, it basically halved the effect that you would have next time. Please help me through this comment I made in the Discord, please. FNF diluted, dragged it down from 50 to 35, then they loaded up, but sold that for less. Well, they didn't sell it. That's the thing, is you have to keep in mind that yes, FNF diluted the stock and it dragged down, and they themselves helped purchase some of those diluted shares, which is them loading up, as you say. But this is not FNF selling shares. They're not selling. They're handing the shares to their shareholders as a dividend, and then the shareholders are selling. Which, fair enough. Selling is selling. I understand, like, it still has the same effect on the stock at the end of the day. But from a capital allocation strategy point of view, it's not FNF selling. They handed it to the owners who already owned it, and then those owners are the ones that are selling. Which is why, like, I don't know what time you hopped into this chat, so I don't know if you caught the early part of it. But it was a little bit before your first comment. I was kind of showing this page right here, and I was kind of going through, this is the shareholders of FNF, and this is the shareholders of FG, and I was trying to like kind of compare what I thought would be a reasonable amount of volume based off of who I would assume would be selling. FNF just distributed FG shares to regular people. Yes, that is exactly what happened. They basically repeated what they did in 2022, at the end of 2022. They basically just did another round of that, but a little bit larger. Which, I mean, you could still, like I said, you could still be frustrated with the decision. Like I said, it's like, you could still say like, why in this order did they do this? There's still questions you could have about it. But then it still kind of also gets to the difference between FNF and FG, where, you can say, that you're frustrated with FNF because they're essentially like the prime owners of the company, but FG's management, I would say, like, I don't have any frustrations with, so that's the thing. It's like, if I just isolate on FG, I'm not frustrated really at all. It's basically all just from the perspective of FNF, which they're sort of like the management because they have majority share. And so essentially the CEO and the board of directors of FNF sort of supersede the CEO and the board of directors of FG. But from an operational standpoint, like within the actual business, it's like, I don't really have any frustrations with them. It's all just from the FNF standpoint. So from a technical perspective, Jeff says, they just distributed, and the selling pressure of megas like Vanguard not needing more FG meant that they sold, so they depressed the price further and maybe panicked. Yeah, basically. That was kind of the math I was doing here, is I was kind of like looking at the major ETF shareholders, as well as like which shareholders did they not have in common. Because I figure, like, if you're an FNF shareholder and you're also already an FG shareholder, then you're probably going to be happy if you receive more FG shares because you're already an FG shareholder, right? But if you're an FNF shareholder and you don't own any FG shares, then it kind of implies that you would probably sell the FG shares if you receive them, right? So I kind of did some math there. I tried to kind of work between the lines there. But yeah, that's essentially what it is. It's just certain FNF shareholders saying, you know what, I don't really want that. And they're selling it off. So that's why I would say, is like, looking at this is like, this is definitely temporary. Assuming you believe that valuation would revert. Of course, technically speaking, it doesn't have to go back up from 5.5 times forward earnings. You know, a stock is not required to trade at any multiple, obviously. But the point is, like, if you assume that, you know, if that is no effect, it has literally no effect on their share count. You know, it's like they had 183 million shares here, and they have 183 million shares here. You know, like there's been no change in share count. There's just been a change in ownership, essentially. And I said at the start of the stream that, like, this particular bad candle here, honestly, I think was more to do with private credit, because there was a little bit of a revamping of some of those private credit concerns in like the first 2 weeks of December. So really, I mean, to be honest, I think it's more just this last candle here, which kind of lines up with, you know, the really huge volume candle that we got too. So since it does sound like you did kind of show up to the stream a little bit later, Jeff, I'll just kind of give you the quick rundown on that, which is that my base estimate was that I kind of had these two numbers here, 4 and 12, which these represent millions of shares. And I took an average of that, which is 8. So my estimate is that, like, at least 8 million shares I would expect to be sold off from FG, and we ended up with 7.5 million shares in this first week. Now I say at least because I could easily see it maybe being double that. So my logic being that it would probably be like 8 to 16 million shares of volume would probably be the likely sellers. And so what I would say is that we could theoretically have another week next week that could be just as bad. Or, you know, or alternatively, you could have that same level of volume spread out over several weeks too. Like it doesn't have to be all in one week. But the point is in terms of volume that I would expect to kind of have to be churned through to kind of work through this process, my estimate was like 8 to 16 million, and we've gone through 7.5 million. So that's where we stand on that, in my opinion. I'm looking forward to the actual Q4 numbers. You know, getting back to the actual operations of the business, I am looking forward to those Q4 numbers, and I'm looking forward to getting the LIMRA report that gives us the industry numbers for insurance. And then the follow-up question there, will more float benefit shareholders in some way, in your opinion? Yes, I do think so. Now, I will say float is kind of a fuzzy concept, and technically there's positives and negatives to having higher float. So it kind of depends on what you expect. But I would say the main benefit to the increase in the float, why this is important. And by the way, they said this when they announced that they were going to do this. This was one of the reasons that they gave when they said it, was that a larger float encourages more shareholders. There are significant amounts of institutions, funds, all sorts of people who have like restrictions on what they're willing to purchase, right? So like if FG is a $4 billion stock, but 5 out of 6 of those shares are off float, right? So that means that the actual float size for FG is less than $1 billion. You know, it's a very, very small amount of float. Like the market cap's 4 billion, but the float size is less than $1 billion. And you have to understand that a lot of institutions, when they're trying to decide like what size of company they're willing to buy and sell into, and you know, when they're making decisions, like they're not concerned with the size in terms of whether they think it's going to increase returns. They're concerned about it because of liquidity. They want to be able to buy and sell in and out of their positions within a certain period of time, you know, without making up a certain amount of the daily volume of whatever that stock is. And so if you have a stock that has a float of less than $1 billion, it really, really, really restricts which institutions and which funds are going to be willing to invest in that. And then that itself is also going to have an impact on how many analysts they get and stuff like that. So yeah, this action basically doubled the float size. Like I said, well, it was less than $1 billion. And so now it's more than $1 billion. I know that literally the billion line is actually like a major marker for that kind of action. I know that 2 billion can also be a major marker, like 1 billion, 2 billion, 5 billion, 10 billion. Those can be common like milestones for that kind of metric. So yeah, no, I literally do believe that this probably could improve the kind of technical, the price dynamics of the company going forward. Now I will caveat that with saying, because like I said, there's positives and negatives to this. It's because, you know, this is we're just talking about market stuff. This has no impact on the actual value of the company. It's all just thinking about prices and supply and demand kind of stuff. So like within that, that technically means that what you're sort of doing is you're increasing the supply. You're increasing the potential supply available to the market, which means that there may have been demand out there that would have loved to match with that supply, but they themselves were waiting for a specific amount of supply to be available for them to even turn their demand on. And so we've turned more supply on without diluting the company. We're turning the supply on in terms of the market, the public market. And so theoretically, there will be more demand. Now, like I said, there could theoretically be less demand. That's technically something you could do. Like I would say, like, this is the same thing as when a company splits its shares, like people split their shares in order to increase the liquidity of the stock. But when you split your shares, you could actually increase liquidity so much that it technically causes somewhat of a downward spiral, because maybe there wasn't much demand to back up that excess supply in terms of share volume. So that's what we're talking about here. I do think this is a generally good thing in the long run. And I'm pretty sure I said that when we first talked about it a few weeks ago. I was like, look, this is probably going to be turbulent, but in the long run, this is good. Because in the long run, what this is doing is it's lowering FNF's impacts on the company in the future. And that's why I said is like the next time they do this, it would probably have half the effect it has this time because they've doubled their float, right? And then the third time they did it, it would probably have 50% as effect as the second time because they would have increased it another, assuming they distributed the same amount. Then they would have increased it more so. And then if they did it a fourth time, it would be a third as much as the third time, and so on and so forth. So it's like it's painful to go through this process, but in the end, it lowers the impact the FNF could have in the future on the share price. So it's pain that, in my opinion, is, at the end of the day, I don't want to say that, we wanted it to happen per se, but it's okay, I think. Just comments, thanks for clarifying. When Q4 slaps and blows it out of the water, ideally, and we'll get our momentum back, and then we'll have more exposure to big shareholders and more momentum. Yeah, ideally. And more shareholders, more institutional ownership, more analysts covering the stock, maybe even too. Like all of that is now more on the table because of this action. So yeah, it's and as we said, it's these funky public market details, these technical details that technically don't really have much impact on the actual operation of the company, don't really have much effect to it. It's like technically, your share price doesn't matter to your operations as long as you don't need to raise capital in the public markets, right? So at the end of the day, it's like it's one of those things where it's like, which considering they did raise capital this year, maybe that's a funny thing to say. But as I also argued during this point, I don't necessarily think I don't think this dilution that happened here was because they needed it to survive. I think they saw it as an actual decent opportunity to expand at a faster rate. It's just, I don't think that in the following months thereafter, I don't think they managed to really give the markets the confidence that was really what they were going to get for it. But then I would again come back over to the financials that we were looking at and say, well, 2024 was 27%. We're down in 2025 in terms of the overall revenues. But we were, in my opinion, like I said, setting ourselves up more for the next year of growth, which, as we already looked at, the analysts, or at least the one here, seems to believe that we're going to get. So yeah, looking forward to those Q4 numbers. We'll see what happens with that. I'm definitely watching this through. It's like, it's hard not to address this one, considering how painful it's been, and it being, like I said, my number one position. And as I said at the start of the stream, it's like, it's actually kind of, like I said, on one hand, I'm pretty pleased with myself that I managed to still beat the market last year, with my number one position down 28% like that. But at the same time, that means that basically, like, all the massive gains I got in the gold miners, all they did last year was basically cover my losses in FG for the most part, which, sucks to really knock one out of the park like that, and essentially it kind of be balanced out by another loss in a way. But like I said, still managed to keep up with the market, which is good. But point is, it feels like last year should have been a blowout year for me. Should have been a massive blowout year, and FG kind of like kept it from being a massive blowout year, essentially. So here's hoping that we get the bounce back this year. So in the last few weeks, I did add a solid handful of more companies to The watch lists, I'm kind of like trying to rapidly go through them. I'm not even 100% sure which ones I added that we didn't necessarily discuss last time. I know I said I was going to do a few more oil majors, which I did. I added a handful more of energy companies into the mix, not just oil, also some pipeline. But looking across the board, and within that, I would say the one that I found that seems to have the most attractive value, at least at first glance to me. I haven't done like a super deep dive, but at least at like kind of first running through the numbers glance, BP seems to be reasonably attractive to me. So if anybody is looking for or is interested in energy plays, I'd say maybe take a look at that. I know I commented in the last show that I've been kind of like watching the oil price, and as it kind of gets to these kind of like 50s levels, it kind of starts to look really, really attractive to me. Because I don't really have strong convictions on like where the oil price is necessarily going to go, but I do sort of think of it as like, you know, likely to be sort of range bound at a minimum. And so if you want to think about like where you think the range is, well, I mean, you can argue about it. It's a lot of supply and demand, and the changes in supply globally impact these things a lot. But to me, when I see prices coming down for like 3 years straight like this, it sort of just looks to me like eventually there's going to be big pops there. I don't know where to what. There is obviously the news that we've had in the last day or two about the actions in Venezuela. So obviously that's going to have a big impact on this. Obviously, a lot of people have been discussing the various motives for the actions in Venezuela, and a lot of people bring up oil obviously as a potential key motivator for what's going on there. And while you have to kind of argue and say, well, what do you expect to happen then with the ongoing actions in Venezuela, we're going to call them, because, well, if there's a conflict going on, that leads to potential for significant damages and disruptions to production, which means you could end up getting that pop in the short term. But at the same time, if the goal of said misadventures is to theoretically try to bring a bunch of oil supply online, well, then that kind of makes this downward trend seem appropriate, doesn't it? So I would say that, you know, try to take those things into account before maybe jumping into an energy play. But nonetheless, like I said, I've been trying to look at some energy plays. I think they're potentially interesting, and I might try to wait for a little bit of an inflection point where it seems like maybe they're turning a corner or something. And it's worth noting that actually, like, I'm looking at oil here, but if you just look at like a lot of the majors, they're not necessarily very down. So it's not like this is they're not necessarily, yeah. So like most of them have been a little bit more flattish in the last 3 years, while the oil price has been coming down. Like it depends on which one you're looking at a little bit. I only grabbed a few of them, but yeah, they really haven't been coming down the same way oil has. And so which is one of the difficulties I had when I was looking at these, because like I said, I did look at a handful of them and I didn't really find a ton of them at first glance to look super appealing. But nonetheless, I was kind of curious to look at them, and I still kind of want to look at a few others. But yeah, so I'm probably going to do some more work on BP. I'm probably going to look a little bit more closely at their operations and their reserves and their productions, and try to like maybe sketch out a little bit more of an actual idea of where I think the revenues are going to go, because a lot of this is just kind of first glance assumptions. Come over here, you can take a look at it. I got, for the next 10 years, I just have 2.4% of revenue growth for the next 10 years. I've got average margins of 5.6%, 5.7%, which is 5.5% was what is average and medians that they had for the previous 10 years. That gets me to net margins of like 2.5%. Downward movement from its current multiple towards 12 over time. And I get, you know, depending on how long you hold the stock, you could get like 10, 11% returns, depending on the time frame you hold it, and a little bit of your luck in terms of the multiple there. Jeff, seems like the oversupply will hurt U.S. explorers producers. I think their break even is $100. I don't think it's 100. I don't think it's that high. I don't know. I haven't seen numbers too recently. I could have sworn U.S. Oh, you explorers specifically, or do you mean like the majors, or do you mean like everybody as a whole? Because like maybe even a lot of the explorers might have a higher level like that, but I'm pretty sure like a lot of these guys like Exxon and Chevron, I'm pretty sure their break even is more around 60, but I'm not 100% sure on that. So, and technically when people say break even, they can also kind of mean slightly different things, because you can sometimes include different things in the estimate there too. So there is that to mention as well. But free cash flow margin is about 5%. Oh, oil produced in the U.S. Okay, that is potentially true. That is potentially true. Okay, yeah, because like me saying 60, I'm talking about all of the production for Chevron and Exxon, but they don't produce most of their oil in the United States. So, but okay, oil produced in the United States, that's possibly true. I'm not sure I've ever actually heard a number on that. So that's totally possibly true. But yeah, I would say that got to keep in mind there's going to be huge variability in that too. It's going to be pretty wide range. Oh, are you looking it up right now? Okay. 60, 75. Interesting. And I do know that those break-even numbers do shift around a decent bit. Like, it's definitely not something where you can look at that number and then just count on the same number like 3 years later. I do know that it does tend to shift around a decent bit. But okay, interesting. Good to know. But yeah, so yeah, I'm like I said, I'm interested in energy. I've been kind of trying to look at a handful of energy names, but definitely trying to take into account the overall global geopolitical picture there, because yeah, if there is going to be a massive amount of supply coming on, well then yeah, maybe you don't really get a huge pop in the oil price. And then but also these valuations I'm doing are based off of their current numbers, right? I'm not doing valuations based off of some future oil price. I'm doing it based off of the current oil price. But also, like I said, the assumptions I currently have put in are very, very simplistic. I didn't actually project out their production and then apply today's oil price to it. I just applied a very, very low revenue growth rate to imply that it's moderate like inflation, 2.4% over 10 years, with it being less than 2% for the first handful of years actually too. So even that 2.4%, it kind of has to accelerate into it, which is just like my conservative assumption for all that. And by the way, I use that exact same revenue growth rate for literally all of the oil majors. I just use it across the board. And then I use their kind of normalized margins based off their history. And that's where pretty much all, and then also the multiples pretty much all trailed down towards their long-term averages. And that's really kind of like what all of those values are based off of, which, I mean, like I said, we got BP, which I see like 20% of upside on. ConocoPhillips was closer to fair value. Enterprise Products Partners, decently overvalued. Exxon looks decently overvalued. Total looks decently overvalued. Yeah, so I went through a handful of them, and really BP was kind of the one that looked attractive, which is worth noting that BP being a foreign company, that could potentially be part of the difference there. There could be a little bit of a premium because of its because maybe American companies getting a bit of a premium there. Though it's worth noting, Total is also not an American company either. So, but different company. So also I've looked at recently at a handful of other names. Uber was one that I was kind of curious to take a look at. I've been hearing a lot more people kind of talking about Uber over like the last year or so. And frankly, I kind of like have slowly been convinced a little bit of some of the potential competitive strengths I think that they might have in terms of automation, AI, and automated driving. I do think Uber's essentially in a good position to essentially offer their platform to a variety of other companies that are trying to do all sorts of things technologically. And I've heard many people kind of talk about this case over the last year. So it was just kind of a company that in the back of my mind, I'd been growing more and more curious about. And then I think somebody in the Discord also mentioned that they were interested in Uber. So it was one that I kind of was just like, I kind of want to take a look at, which I think we can make a pretty good argument for it being reasonably fair value about where it's at. Looking at the assumptions I have for that, I have 7.5% revenue growth on them relative to the last 10 years has been 35-36%. So me saying that they're going to get single digits revenue growth, I'm just saying 7.5% revenue growth. Their margins, I'm saying, are going to continue to grow. So that's like one thing in there that's a little bit of a attached to that is that this is a company that's been going from lack of profitability to profitability. If you look up at the operating margins here, because he went from negative 78, 79%, negative 49%, negative 27%, negative 66%, negative 40%, negative 22%, negative 6%, positive 3%, positive 6%, positive 9%. Right. So you can see that there's been a little bit of a, they've inflected to proper profitability finally in the last handful of years. So the question you'd have to say is like, okay, well, what kind of margin do you think that they can kind of last out to permanently? And so I did kind of make some assumptions about that. Like I said, they're at 9% now, and they've increased by 3% the last 2 years, right? They went 9% improvement in margin, 3% improvement in margin, 3% improvement in margin. So I basically argued that they could probably get another 3% improvement in margin over the next 10 years. I think that's a pretty reasonable assumption to put in there. Are they still doing SBC and dilution? Yeah, I would assume so. I can't remember off the top of my head, but I would assume so. Yes. SBC as a percentage of sales in the last 12 months has been 3.6%. And that's relative to the kind of average of 7.4% over the last 10 years. But there was 1 year where there was a huge dilution in there. So that's probably skewing that average. And then the median's 4.6%. So, and you could, I would say, like, it looked like there was a very low levels here, and then there was kind of some higher levels here. And then it does sort of look like in the last 3 years, it's starting to go down. And that going down probably is because of the revenues going up. It's worth noting because this is SBC as a percentage of sales. So yeah, they're still SBCing. But you know me, I always adjust my cash flows for SBC. I always include that assumption. So as far as I'm concerned, SBC is just an operating cost like any other, as far as how I treat it in valuations. So like these margins would include that, effectively speaking. But yeah, so it's interesting company. Like I said, I don't think it's a slam dunk bargain. Like I said, I think it's sort of fair value-ish. But it was one that was interesting. Like I said, I think the business is interesting. So it was one that I was curious to take a look at. If it was to drop 25% or something on earnings, maybe I'd pick it up or something. I don't know if it would drop 25% on earnings or something, but maybe. The point is, I thought it was an interesting one that might have some serious, competitive strengths that it's built up for itself that could play into some good strategic partnerships depending on what happens with technologies in the coming years. So Uber, interesting. Like I said, not necessarily a slam dunk value, but it was worth looking at. Also, I may have talked about it last time we talked about Adobe. I've been looking at a lot recently. This one I think is much more interesting. Jeff's got some errands to run. Nice hanging out with you, man. Yeah, he'll watch it on replay. You have a good year, man. All right, catch you next time. Yeah, so Adobe is another one I've been looking at, and this one I definitely think is maybe even more interesting. But it admittedly, there's plenty of assumptions you kind of have to assume about this one as well. Yeah, like and subscribe, Jeff says, please and thank you. Like and subscribe, those who are watching on the replay. So Adobe obviously is caught up in the let me actually go take a look at the stock a little bit too. In fact, look at Uber. I didn't actually pull up Uber, but yeah, you can see here is like Uber actually is in a little bit of a drawdown, which I think is somewhat why I'm finding it fair value, because I'm pretty sure when I first started looking at the numbers, it was actually like a month or two ago, and it didn't look as attractive when I first started looking at it, and it did start looking attractive, and I was kind of wondering if it was some of the changes I made versus the stock coming down. But at the same time, so technically speaking, Uber has come down a little bit, but you can see it's had a pretty good 2025, that's for sure. But anyway, switching over to Adobe. Obviously, Adobe is one of the big names people have been talking about in terms of potentially being diminished by AI. And so my taking a look at it is definitely considering the alternative and basically saying that no, actually, what if AI doesn't have a major effect on Adobe's business model, or if it does have an effect on Adobe's business model, it's much less and much slower than people assume. And then obviously there's a potential that it could even be a positive for Adobe. I've heard people give the case for that, but obviously the stock is being treated like there's no positive case for Adobe. Now, it's also worth taking into the context that Adobe was trading at pretty high multiples previously. So with, if you're part of it coming down is it just kind of readjusting potentially to the fact that it was probably significantly overvalued prior to that, depending on what you want to assume about it. But 40s forward multiples is pretty high, within the context of obviously really, really high revenue growth. 18% for the last 10 years, 22% for the first 5 of that 10, and then 14% for the back half of that. But we were just looking at the Uber numbers, right? And like the Uber numbers had even higher revenue growth rates over their historic periods than that. So kind of a similar thing of valuations being high level growth stocks. Also also a pretty high margin company, which tends to increase your multiple to a significant degree. Free cash flow margins about 30%, and that's 30% net of SBC. As I mentioned before, I always think of cash flows net of SBC. So pretty strong cash flow generating company, very, very high multiple, relatively strong growth rates, subscription model, which creates low volatility in the fundamentals themselves. So you can see there definitely has been a little bit of a downward trend in terms of the growth rate, but I would say it's not like a super strong downward trend. And also it's worth noting that the downward trend in the growth rate, you can see like we were kind of mostly 20s growth rates with a 15 in 2020, but we were all in 20s except for 2020. We had 20% growth rates until 2022. And then 2022 hits and suddenly it's 11%, 10%, 10%. And that's also going to be, it's like 10.8% on a compounded basis since the end of that. And so within that, and I also kind of like look at within different scopes as well. It's like the pre-COVID growth rate was about 23.5% compounded. And then the sort of the 4 years trailing prior to the interest rate hikes was 21.3%. So you see like even the post-COVID timeframe, technically there was sort of a slowdown in the revenue growth a little bit moderately, which you could argue is more having to do with the immaturity. So it seems to me that like really the revenue growth rate did slow down dramatically right after the interest rate hikes. Now it's worth noting that ChatGPT sort of came out like a similar time frame to like about a year later or 6 months later, depending on like when you think about adoptability too. So like people looking at these slowdowns in growth rates, I think a lot of people are thinking of it as because of ChatGPT, but I don't really think it is ChatGPT. I think it's the interest rates that cause this, because you got to think about all the other companies who would be buying that would probably be limiting their spending because of increase in costs of that nature. So anyway, looking at my assumptions, like I said, I put 7.1% revenue growth rate in for them. So that's sort of assuming that we're going to have still kind of a downward trajectory in terms of the revenue growth rate, but it's going to be based off of the already conservative basing from 2022 onward. And I feel pretty comfortable with that. Going forward with that, I have operating margins of 36% at the start, kind of trailing downward to 31%. So it's like about 35% on average, ending at 31%. That's relative to the about 32% that we see on average. So yeah, it starts a little bit higher, but it's worth noting their margins are higher currently. So I'm essentially saying that it's just going to kind of downward trend towards their long-term average of margins. And same thing with net margins, same thing with cash flow margins. And then with the multiple, I'm largely keeping it about the same. Like it technically has a little bit of a downward movement from its current level. So there's no mean reversion multiple. As far as I'm concerned, the multiple coming down was correct. Like as I was showing over here, it's like, as far as I'm concerned, this is fine. You could argue that 15 for a forward multiple is still too low for a company that's going to grow 7% and have 30% margins. But the point is, I'm pretty comfortable with making my valuation based on that. And this is a forward multiple, whereas this is a trailing multiple. It's worth noting. So that's why this is a bit higher. It's because these are trailing multiples. So like within that, I mean, I see easily 10 to 11% returns compounded, 25% upside. The way I calculate these valuations is somewhat different than some of my previous models. It somewhat takes into account the uncertainty of how long you're going to hold the stock. Like I kind of tried to take into account like what would the COGR be if you held it for 1 year, 2 year, 3 year, 4 year, 5 year, so on and so forth. I kind of have that going on over here. So I'm saying like, well, depending on how long you hold it, what's it going to do? Which kind of compares to my previous way of thinking about valuations in the past. I largely just did 10-year valuations in the most like purest academic sense. And then that was the way I ran my portfolio. But I'm trying to kind of use a more, what I would call practical approach, where like, yes, we're thinking about what would that kind of 10-year compounded long-term permanent holding of the stock be, because that's kind of how I always thought of it. It's like technically it was 10 years of fundamentals, but the idea was that if you're going to permanently hold a stock, here's the returns you're going to get, right? And so I still try to think of it in those terms, but I also try to think about like, well, but realistically, are you going to have to sit through a few years where there isn't good returns in order to get to the end point where there is good returns, right? You sort of want to maybe account for that fact. Like if there's a stock where you can pretty confidently have good returns all the way through, wouldn't you rather have that rather than the stock that you have to wait 5 years for the returns to show up, right? So my new way of kind of like looking at these, I sort of try to take all those things into account. So like down here, for example, here I have the median of those IRRs I show here, because I'm sort of like, well, I don't really know which one how I'm gonna end up with. It's like maybe I hold it for 1 year and I get basically 0% return, which is what it kind of shows here. Maybe I hold it for 2 years, which shows 6.5% return. Maybe I hold it for 10 years, which shows 10.5% return, right? And like I said, don't get too hyper attached to any one of these numbers. I'm sort of trying to be a lot less, I guess you could say, precise about my valuations, and kind of trying to create more of just like a general feeling of the value with my valuations now. That's sort of like, I guess, a major change I had in the last year. I didn't really talk about it a ton, I guess, but I did talk about my two new templates. I was working on those last year, and I know I mentioned them a few times, how they had changed a little bit, but I hadn't really gotten into a lot of the specifics of it. But that is sort of kind of one of the major things that kind of changed my thinking about investing last year, is that when it comes to doing valuations, I'm sort of trying to be less precise and more just kind of have a general feeling for it, and not be overly attached to one number, I guess you could say, which I sort of did with my previous valuations by having the distributions. But nonetheless, things still can be very, very precise in terms of like, this is my one assumption about what it is. Like I'm kind of just trying to say like, well, the returns could be this, or it could be this, it could be this. Maybe you hold it for this long, maybe you hold it for that long, rather than saying, no, we hold it for 10 years and this is what the returns are going to be. So long way to kind of put that together. So anyway, that might be it for today. We talked about a decent amount of the stuff that I wanted to talk about. Not quite everything, but or I guess there's a couple more things I can give. I would say going into this, we did get the Q3 GDP numbers, which were better than expected, and a lot of people were surprised by that. I heard a lot of people kind of, poo-pooing the numbers and kind of, making their arguments about why they disagree with the numbers, the shutdown, kind of limiting the ability to gather the numbers. But I would say that, well, I do think this is a stronger than expected number. That being 4.3% of real GDP versus, for example, the Fed's GDP Now model was saying 3.47% was sort of what they're expecting. But you can compare the blue and the green lines. You can see like they often have some variability within them, and sometimes the blue does outperform, and sometimes the green outperforms. So we've had quarters of that strength only somewhat recently, like back in Q3 2023, we had 4.7% real GDP growth. So it's not like that number itself is an impossible number. And technically some of the dynamics in the exports and imports were favorable to that mixture this time around. So while this does seem like a very, very strong number, it's probably within the context of the kind of the ebb and flow of an average. This is one thing, is like people, when it comes to GDP reports, I think people tend to get very, very attached to the specific number that comes out. But I think that that's really not good, because the way they report GDP is that one singular quarter, whatever the quarterly change was, they compounded out 4 quarters to tell you what the rate would be if it grew at that rate for 4 quarters in a row. But GDP never grows the same rate for 4 quarters in a row, right? It never does. Look at it right here, right? Here's GDP on a quarterly basis going back to the 40s. Basically every single quarter it zigzags up and down. Like there's like a couple of these, there's a couple times where it's very, very close to the same number as it was last quarter for like a few quarters in a row. Like there's some periods where you'll see that, but for the most part, it does a pretty constant little zigzaggy kind of motion there. So when you compound that number out, which, because what we had was 1.1% growth in GDP, in real GDP in that quarter, which is a strong number. We had close to 1% in the quarter prior to that, and then we had down 16 basis points prior to that. So it's like, really, in my opinion, like, people report the single quarterly number and they compound it out. So this is the number you'll see reported in all the headlines, 4.3%, which is 1.1% compounded 4 times. But in my opinion, that tells you something about that quarter, but that doesn't tell you much about the trend of GDP. I like to look at the year-over-year change of real GDP, because the real year-over-year change of GDP, yes, it ebbs and flows, but it's a lot less volatile. So looking at that, the year-over-year change in GDP is at 2.3%. That 2.3% includes the down quarter we had in Q1. So it is true that by the time we get around to the Q2 numbers of this next year, it'll likely revert out, and we'll probably be back at a little bit of a higher level here, because you can see back in 2023 we were up at like 2.8, 3.3, a little bit higher up there. So it's very likely that this 2.3 number is a little bit of a low in the ebb and flow. But the point is it has a lot less variability to it. So 2.3% drifting upward, because we've recently had 3% and 4% quarters. And then I personally don't see really any reason why Q1 wouldn't be a good quarter as well. I've shown plenty of my other charts in other live streams, and we'll probably have another live stream where I show a bunch of growth related charts, but we're not going to do that necessarily today. The one thing I would just point out is, coming back over to the GDP Now tool, is that they do have now a prediction for the next quarter. As the new quarter starts, they start to collect data and they start to put the report out. And the GDP Now is now currently predicting 2.97, but it's worth noting that this number updates like constantly. Like, basically every time a new data point somewhere comes in, they're updating this model, and the number gets updated until the end until the report of the actual number comes in. So the point is that can change. And also, I would point out the one thing I kind of want to talk about is that the Fed does that, the GDP Now tool, which is basically them trying to nowcast based off of all sorts of economic data that comes in. But they also have the St. Louis Fed's Economic News Index, which basically is also a real GDP estimate tool, but it's based off of news. It's based specifically off of how the news reports the economic information, which I think is very interesting to kind of compare the two, because they do tend to have very, very different numbers from each other constantly. So here, for example, I subtract the two from each other. So here I have the news base index, subtracted out the GDP Now, which is the actual data-based index. And so here you can see that shows periods of time where one's higher than 0 and periods of time where one's lower than 0. And so if it's higher than 0, that means the news index is projecting a higher number than GDP Now. And if it's lower than 0, that means the GDP Now is projecting a higher number than the news index. And I think you can kind of think of this as like an economic news sentiment gauge, because what this will tell you is sort of like how much is the news reports reporting negative relative to the actual data. And so, like I said, if it's below 0, that means the news is very negative. If it's above 0, that means the news is or if it's below 0, that means the news is very negative relative to the actual truth. And if it's above 0, that means the news is actually very positive relative to the actual truth. So that makes sense here. Like, for example, Q1, we actually had actual decline in GDP, right? We actually had a real decline, or my bad, that was actually in Q2. Or Q1, I'm confusing myself. Q1. My bad. I should have known, because obviously it was right here. We had an actual decline in GDP, which means the real data was actually bad. Now, obviously there was lots of negative news in Q1, but really I think that the real negative news started to show up more after we got that report. So the point is, like, here you can see on that. So what I would say is that whenever it's below 0, I would say that there's arguments to be had that there's going to be surprises to the upside. That's what this shows. But I would say this also, it only gives you a quarterly number. So because of the fact that it's only a quarterly number, means it's not very good at predicting things. So like looking here at Q4, I would point out that uh, the Q4 shows a negative number, which means that currently speaking, the news is being much more negative than the data is showing for Q4 so far. Like I said, other than this one indicator, the one point here, I don't think this is a very good like signal for doing anything with, but it can give you some context of what's going on in the information out there. Because yeah, I think it's very easy to be convinced that the economy is very bad if all you're looking at is the headlines. But if you're actually looking at all the data, yeah, there's things that are not good, but there's also lots of things that are good. So it's one of those things where it's like, I think it paints a different picture when you're actually looking at the actual data. And I did want to include like one little data point to kind of show like why I do think that there's good reason to believe that Q1 in 2026 is going to be pretty good economically. And I would suspect Q2 probably would continue to be good because a lot of this kind of data doesn't necessarily roll over super quickly. So it's one of those things where it's like, if it looks good now, there's good reason to believe it's going to continue to look good for the next handful of months at least. That's just how this data tends to look. So here what I have is loans and leases in commercial banks. So this is loan growth on a year-over-year basis, and I've adjusted it for core PCE. So I adjusted it for inflation. And then I also have industrial productivity, which is a very, very strong correlated measure with GDP. Like productivity is basically the thing that correlates with GDP the best out of pretty much everything, to be honest. And so looking at this, you can see like in the last year, it's just been accelerating, literally just an acceleration out of a low basin, and which is consistent with a lot of the narratives I painted around the economic news and the story for the last year or two, which is to say that, to be honest, I think we sort of had more like a shallow recession in 2023 or so that may have dragged into 2024, depending on like which metrics you're looking at. And then we've been sort of coming out of it in the back half of 2024 and in through 2025. Depending on which metrics you look at, it sort of makes the recession look more like a 2024 thing, and other metrics make it look more like a 2023 thing. Like for here, this one, it sort of makes it look more like 2024. But personally, I think it's more of a 2023 thing, because by 2024, a lot of the numbers were already starting to kind of accelerate out of it. So, but here, these ones though, bank credit being extended and productivity growth, which, looking at the charts, you'll see that they are highly correlated with each other. There's a reason why I have them both on the same chart here, is that you can see just how correlated they are with each other, which makes sense if you think about it. It's like a bank is going to extend you credit when they believe that you can do something productive with that credit, right? I say this as somebody who works in bank credit. I'm a commercial banker. I know this. I literally know this. So yeah, that is how it works. And this is something that happens, generally speaking, into accelerating economies. You can have these measures accelerate just prior to a crash. So I'm not going to pretend like that's impossible. You can look on the time series, and you can see that there are points in time where loan growth is quite strong before a recession. And then it's in the recession that loan growth just falls off a cliff. So loan growth doesn't necessarily disappear right before a recession. But productivity tends to be pretty consistent, though. It tends to not be super strong going into recession. It may not be negative going to recession. It will be negative because of the recession. But it will at least probably be declining prior to the recession. And for example, I would even say like a good sort of historical case to look at is sort of back here in the Great Financial Crisis, because you can look at it like this way. It's like, look, we came out of the dot-com boom. The dot-com boom had strong productivity and strong loan growth, right? You can see right here, strong productivity. And then we had the recession and of the dot-com crash, and productivity fell. And then productivity came back up into positive territory, and loan growth came back up into positive territory. And then here in like 2004, 5, and 6 or so, loan growth just accelerated up towards almost double digits, whereas productivity, it was positive, but it wasn't very strong, right? And so you could almost see how like the gap between the two was the excess credit that was being made that eventually created the financial crisis, right? You can sort of see like how the gap there, that large gap there, almost created those conditions. Now, obviously, you can see there are other gaps periods of time. So that doesn't mean it has to end in a crisis because you get a gap there. But I'm just trying to show you that these two are pretty highly correlated, and that even when they become uncorrelated, there can be consequences to that uncorrelation. And then like I said, zooming in on the last few years, it sure looks like things are going reasonably well in throughout 2025. Like literally, it's been almost nothing but a constant acceleration of these 2 time series through the entire year of 2025. So my base case is not to assume that Q1 or Q2 of 2026 is going to be a recession. I know a lot of people that seem to believe that we're like for sure going to have a recession because of mostly I hear it because of like the tariffs. That seems to be the thing that people want to blame it the most on. Which I mean, like I said, I'm not a big fan of tariffs. I do think that they are economically damaging, but I think the overall economy is just much larger and much stronger than that. So it's like just because you get hit doesn't mean you go down, right? Like just because something hits you in the face doesn't mean you go down, and that's the U.S. economy. So point being that I think the economy is looking reasonably good going into this next year. I'll let you know when the data turns around, because I'm certainly not married to some optimistic view on the economy. I like to think that I'm pretty reasonably unbiased when it comes to specifically a lot of the politics stuff that I think really trips up a lot of people to both directions, for the record. Like I know so many people that are way more bullish and don't really have good database reasons to be so. And I know a lot of people that are very bearish that don't really have good database reasons to be so. So I think I'm reasonably good at kind of ignoring those things and just looking at the charts, the data charts. But anyway, so that's gonna be it for today. Hopefully that was an enjoyable show for those who caught it. Please do like and subscribe if you haven't already, and if you're watching on the replay, it'd be really appreciated. You can also join the free Discord. The link is in the description below. I didn't manage to get a link into the chat, but it should be in the description below. And I will catch you all hopefully in 2 weeks. All right. Bye.